Would you pay $1,800 for this book? This is crazy. Margin of Safety, Risk-Averse Value Investing for the Thoughtful Investor. What a boring title. That's $14 a page. And you can buy that on Amazon for $1,800 if you want to. Now, would you pay $1,800 for any book? What if it was written by this guy, Seth Klarman, and he's focused on value investing, just like Warren Buffett. He manages over $26 billion of assets. So does that change your mind? Would you pay $1,800 for that book? Are you curious what's inside that book that could be worth $1,800? Well, I was curious. I read the book, and I believe that the principles in this book can be more effectively applied in real estate investment. So here are the 5 key lessons that I've learned reading this book and how you can apply it to your real estate investment strategy. My name is Eric Martel. I'm an entrepreneur and real estate investor. I've done over 650 flips over the last 10 years with Martel Turnkey, over $85 million in real estate transactions, and I'm here to help you make more money. And if this is something that you like to, make sure you like and subscribe. Lesson 1 is exploit market inefficiencies. Klarman claims in his book that markets are often inefficient, presenting opportunities for investors to take advantage of. So what are the causes of inefficiencies? Unequal access to information is one of them. Emotional decisions, emotions leading to these irrational decisions. Liquidity, having access to cash and leverage, and technology. So the normal stock market investor, normal stock market investors like you and me can't find really inefficiencies in the market. If you look at unequal access to information, something very basic, economic data, inflation report, unemployment report, all these kinds of things. Even if you get the information at the same time as a professional stock market investor, what you're going to see is that the professional investor is going to know exactly what that means, how it affects his portfolio, what opportunities are out there that he or she can take advantage of. You as a normal stock market investor, just like me, it takes me a while to figure out that, hey, I need to do something here, or maybe this stock would be affected by that because the inflation is up, or the price of oil went up or went down. Then how would it affect my Walmart stock? How would it affect my Apple stock or Facebook and stuff like that? So it's hard. It would take a while for me to think about that. I would have to read and listen to other people to determine how that would affect these stocks. Professional stock market investors would know exactly how it affects the stock, what opportunities are out there for him or her to take advantage of. So this is number 1, unequal access to information, and really being able to process that information as fast as possible. Then you have emotions leading to irrational decision. So the whole thing of fear of missing out. If you go back to the dot-com crash of 2000, or the dot-com bubble, prior to that, from 1990 to 2000, everybody was investing in the stock market. Everybody was buying IPOs, and they would hold on to that for a month or two. They would sell it for double what they paid for. It didn't matter where you threw the dart. It didn't matter what stock you bought. Everybody was buying. Everybody thought they were a genius. Everybody thought that they could quit their job and invest, as like a normal investor in the stock market and make a fortune. Of course, that came crashing down when the bubble burst in 2001, and people realized that maybe they're not as smart as they thought they were. But there's such fear of missing out that everybody was investing in that. I was working in New York City at the time, before 2000. Everybody, even the receptionist, was watching CNBC, looking at the stock market, and they were investing in the stock market. They were buying IPOs. Crazy. They didn't want to miss out. They were just buying because they knew that a couple of months later they could make a great profit. So this is the emotions kind of like leading to irrational decision, even if these companies were losing money, so it didn't matter. You were still making money, and then people were buying that. And these create bubbles, these kind of situations. Then you have simple liquidity, cash issues. Sometimes there's a great opportunity out there in the stock market, but you don't have access to the cash to take advantage of that. The professional investors, they have ways to leverage, to do margins, and then to be able to invest even with the money that they don't have. So this is something that you have to compete with. Then you have technology. The professional investors in these big investment firms, they have access to tremendous amount of technology to give them all kinds of signals. They have software that actually read announcements from the different sources and understand that, oh, inflation is going up, oil price is going down, and then they all automatically create signals for the investors for them to take action right away. You don't have the access to that information. You can't compete with that kind of stuff. They also have software that trade automatically on the stock market based on signals. They know correlations between when this stock goes up, that means this stock is going to go down. All these things, you don't have that kind of software. I mean, you could potentially build it and test it, maybe, but unlikely that this would happen. And I'm not even talking about high-frequency trading, where some of these investment firms actually have antennas to accelerate the speed of transaction between markets, sending signals from Chicago to New York in order to take advantage of very small differences in stock prices for a particular stock between markets. You can't compete with that. So this is the stock market. And then Klarman is claiming that there's a lot of market inefficiencies that the disciplined investor could take advantage of. I don't think so. I think this is very unlikely that you would be able to do that as a normal investor. Maybe it works for the professional investors, but not for normal investors like you and me. But again, I think this is a great principle to remember, and I think it would be more effectively applied for normal people like you and me if we were to apply those rules, these principles in the real estate market. Real estate is full of market inefficiencies. We have unequal access to information. Most people don't go and try to find off-market properties. They don't talk to wholesalers. They don't go and have a team of VAs that are going to call property owners and then ask them if they're interested in selling the properties. You can't do that in the stock market. This is having unequal access to information. Some investors have that information, others don't. And that means also, that applies also to probate, that applies to foreclosures, pre-foreclosures. The information is out there, but not everybody is looking at that. So unequal access to information is definitely something that is out there for real estate market. And this is something that you, like any average person, can actually go and look at to make decisions and understand where the real estate market in a specific area is going. Then you have emotions that are leading to irrational decisions. So you do have that in the real estate market, and you can take advantage of that. Obviously, you look at bubbles in the West Coast in California that are kind of like coming down a little bit, and then and you don't have these kinds of situations in other markets. I invest in the Midwest. The market has been going up steadily in the last 10 to 15 years. We haven't seen any corrections, and so far things are running pretty smoothly. So taking advantage of that and removing that emotions out of real estate investing is very important. Cash needed to invest, liquidity. So this is something that's very important. Initially, when I started investing in real estate, I was in California and I was trying to invest in my neighborhood. You needed a lot of cash to invest in California. You have to buy the property, maybe if you're lucky, you can get it below $1 million. Then you have to put like maybe $500,000 in repairs. You have to get a lender because I don't have that kind of money lying around. So that means that my return is going to be very low and it's going to be very high risk. I'm going to have to put a significant amount of money on that investment, and and it's going to be locked in for 6 months, 9 months, 12 months, maybe more before I see my returns on that. The good thing about it is that when I'm ready to sell, in the stock in California, it was very easy to get a buyer at that point. You basically have an open house one weekend and then the house is sold. Not so true right now because they kind of like the market has softened, but it was very true then. It's what you can do that. So you have to find some kind of investment type that makes sense for the cash that you have available. So commercial real estate, multifamily also requires a lot of cash. So you have to either find some investors that are going to help you fund these deals or all that kind of stuff. But this is something that's going to be a determining factor as a real estate investor. But it's something that's accessible compared to the stock market investors where you can't really do that. Then you have technology. So access to software to basically quickly find, analyze, and execute on deals is going to be critical. A lot of people are using spreadsheet. With Flip System, we have a software that helps you find. We have a property marketplace. We have a property analysis tool that's all together that helps you find, analyze, and execute quickly on these deals. If you have access to a software like that, like Flip System, this is great. This is great technology to help you do these trades faster. The faster you do these trades in a hot market, the more successful you're going to be. Now, how do I apply that? I'm only talking about the rule one here, market inefficiency. You want to go to markets that you can afford, right? So if California is too expensive, you have your money locked in for too long, go to other markets that are out of state. I invest in the Midwest because I can do many deals all at the same time. The deal size is much smaller. That helps me because if I don't have too much cash, I can buy multiple properties. It also helps me reduce the risk because now I have 5, 6, 7 properties that I'm invested in at the same time. And then if one of them makes a great profit, maybe some of them doesn't do such a great profit, on average, I'm doing very well. So this is kind of what one of the advantages of finding the right market and the right investment type for the amount of money that you have available. Then you want to have a local realtor as part of your team. So if you're going to invest out of state, you live in California or you live in Florida, you want to invest in, let's say, Cleveland or Detroit, then you want to have someone local, a realtor, someone that knows how to speak to real estate investor and knows what you're looking for. And then they can direct you into the right neighborhoods, the right streets where you can invest in, because they are aware, they have information. Again, we're talking about market inefficiencies here, about information inefficiencies. So they have information that other people don't have access to. They know other investors that are looking to buy in the area. They know the market rates. They know what the value of a property. They know a lot of information that would be very helpful for you as a real estate investor. Then you can also find off-market deals. We've talked about it a little bit, but yeah, you have foreclosures, you have wholesalers, you have probate, you have all kinds of access to information, and you can really find these off-market deals yourself. You can call people and find out if they're interested in selling their properties. There's lots of software out there that's also going to show you the properties that are available, who the owner is, and even the phone number, and then you'll be able to call them and ask them if they're interested in selling their property. You also want to invest in property types that make sense for the amount of funds that you have available. So that's why my recommendation for the people that are getting started in real estate investing is to invest in single-family rentals, preferably in the Midwest, where the prices are relatively low and you have multiple exit strategies. So that really reduces the risk. Also, it gives you the opportunity to execute these deals more quickly. So a typical project for us in single-family rental, from close to close, when we buy it and when we sell it at the end, when we're flipping it, could be like 5 to 6 months. So this is very easy to execute, as opposed to these larger projects that we would have to deal with in California that could be 1 year to 2 years in order to renovate the house completely. That's why we like the single-family rentals, multiple exit strategy to reduce risk, also lower price, where you can also buy more than one property at the same time, and so that way your cash is leveraged as best as you can. And then if you can, is use a software like the Flip System software to quickly find, analyze, and execute on deals, communicate with your team on the ground, and all of that. So Flip System has a software that is connected to MLS and other sources of information for off-market deals. It also helps you quickly analyze these deals. You just pick them from the marketplace, and then you can analyze them right away. And then you can also connect with your team on the ground, with your realtor, and ask them some information about that, and so that you can purchase the property and get through it very quickly. All right, I know this is the end of lesson 1. So I know lesson 1 is big. The other one are not as long, I promise. Number 2 is do thorough due diligence. So the book really talks about having a comprehensive understanding and doing research about where the market you're going to invest in, the stock you're going to invest in, and all that kind of stuff. Do thorough due diligence and really understand the stock, the company you're invested in. For the real estate investor, it's a lot simpler. You want to understand the market you're investing in. You want to invest in the state, you want to the city, this neighborhood, even the street sometimes that you're going to invest in depending on your investment strategy. So this is something that is much easier to do. There's a lot of data out there that's available. When I got started, I used the Bureau of Labor Statistics and the Census Bureau data to collect a lot of information about the different cities and the different zip codes, and try to find out like what were the markets where I could find the best single-family rentals, or that had the best potential to find single-family rentals. So that was really helpful. And this is when we came up with Memphis, Cleveland, and St. Louis, and that's how we got started. Then you would also get information from your team on the ground, the realtor, about really identifying the neighborhoods that make sense. This is the kind of value that your real estate would bring in, is understand the neighborhood you can invest in and the street even that you can invest in, because they know what the path of progress is, they know where the demand is, and they know where the great properties are. I was investing in single-family rentals, so for me, landlord-friendly estates was something that was very important. Again, that's information that's available out there, and that's the states that we focus on. Then you want to determine the property value. So what is the after-repair value of the property? How much rehab do you want to do? Do you need to do on the property to bring it to the standard of the neighborhood that you're investing in? You want to know how long that project is going to be. You want to know your financing costs and all that kind of stuff. And once you back all that in, you want to come up with a number that you're going to make an offer on. What price are you going to offer the seller? So it's great if you have a software that can do that, like the Flip System software, where you can basically plug all these numbers and you know exactly what your return is going to be, and then you can calculate what your offer price should be to make sure that you make a good profit and that you'll be able to sell the property at the price that you're looking for. And then finally, you want to rely on inspections and your contractor. So you want to have a house inspection, you want to have your contractor walk through the property and provide as close as possible a fixed bid, fixed rehab bid. So that's going to make sure that you have all your numbers, as close as reality as possible. So if you work with a contractor for many years, it really helps because they know you're providing them value every time. They don't have to worry too much also about changes in the scope of work. You don't have to tell them what paint to use. You don't have to tell them what kind of toilet and countertop to do. They know exactly what scope of work you're working on, and they can apply that to the property and really provide a good estimate, a good solid estimate for the rehab bid. So once you have that information, again, review that with your coach. If you're part of Flip System, you have access to a coach that can review all that. They can review the house inspection, they can review the contractor's bid, they can review all of that, and then you can talk to your team on the ground on top of that. So you have a lot of eyes on your deal, and that's really, I can't imagine a more thorough due diligence than that. And then once you execute on the deal and you purchase the property, there's still going to be some adjustment, but at least it's going to minimize the risk and minimize any kind of differences from what you had estimated and what the actual cost of the project is. Lesson number 3, focus on value rather than market trends. So Klarman basically says avoid hot markets, avoid all these trendy things, and that whole fear of missing out. These create bubbles, and then bubbles are great at the beginning, but they eventually burst, and you don't want to be caught in a bubble exploding in your portfolio. For the real estate investors, we see that as well. You want to avoid these hot markets. What's a hot market? It's a market where there's a ton of demand out there, where there's also a ton of real estate investors that are investing in these markets. So what happens is that the prices go up rapidly, and it's very hard for you to find deals, and it's very hard for you and it basically increases your risk, because then you don't know if you're going to get caught in that bubble bursting. You want to go into these, what I call boring markets, so kind of like low sustainable growth, about 1%, population growth, business growth. You also want to have good business diversification, so in these markets. So you want something that's not focused entirely on one industry. So if there's a problem with that industry, then the whole thing collapses and then the unemployment rate goes through the roof. So you want to avoid that, but still good markets, low growth, and but sustainable growth. This is what you want to find. That way the demand is more in line with the supply, the inventory of properties that are out there. This is where you're going to find deals, and this is where you're going to be able to do also very good on the sale. Then you want to buy distressed property. You always want to buy properties that are undervalued compared to their potential. So when you buy the distressed property, you're going to plan for rehabs and then bring it to market value, and there should be a big gap in there, and that's your profit. Lesson number 4 is long-term perspective. Klarman says that successful investors don't focus necessarily on the very short-term trades. They focus on long-term value for these companies. Of course, Klarman is a value investor, so he's not focusing on doing day trading. He's really focusing on the value of an asset, and considers that that asset is undervalued, and it is looking for that value to actually reflect what he considers the intrinsic value of the property, and this is where he makes his money. For the real estate investor, how would you apply that? You do want to have a long-term value. Often I talk to investors and they say, well, I'm going to wait for the market to go down and then I'm going to buy. I'm going to wait for the interest rate to go down and then I'm going to buy. And then the interest rate goes down and they still don't buy because they want the interest rate to go down further, or there's something else. There's never a perfect market, because when the interest rate was 3%, 3-4 years ago, people were not buying because of some other reason. And then, so there's always a reason to not buy, but it's always a good time to buy real estate, and it's especially if you focus in the long term. So if you have a long-term view and a long-term plan for your portfolio, your real estate portfolio, you're going to be fine. So how do you do that? Obviously, you need some capital in order to build that passive income portfolio. Not everybody has $2-3 million where they can just buy a whole bunch of turnkey single-family rentals. So very few people like that. But if you don't have the capital, that means that, yeah, you're going to have to do some flips. You're going to have to buy some distressed single-family rental, renovate it, rent them out, and then you're going to have to sell them. But as you go through 1, 2, 3, 4, 10 of these properties, you might find that some of them are worth refinancing and keeping them in your portfolio. And this is how you're going to build that passive income portfolio. You're going to do 3-4 properties, and then maybe the 5th one is going to be a good one for you to refinance. You're going to go through the refinancing process, and you're going to continue flipping in the meantime. And as your portfolio of rental properties increases, you might decide to reduce the number of flips that you do, and then just focus on your passive income. So that's how you're going to build that portfolio. Lesson number 5 is reduce risk. This is another duh, really, because, of course you want to reduce risk. So how do you reduce risk? Well, you want to invest, if you invest like me in single-family rentals, you want to invest in markets that are investor-friendly, landlord-friendly. So that way you don't have the government actually telling you that, oh, you can only increase your rent by this much, or you can't do this. All kinds of restrictions that you don't need to have. That's why I like the landlord-friendly states. Another way to reduce risk is to build a good relationship with your team on the ground. These are professionals. If you build a good relationship with them, they're going to share information of what they see in the market out there. They're going to advise you whether you should buy a property or not. They can also bring properties to you that they think is a good investment that may not be on your radar. As we mentioned earlier, you want to do a thorough inspection. You have to have your contractor walk through, get a solid bid, get all the information that you need in order to make your decision before you sign the closing document. Ideally, you want to choose an investment that has multiple exit strategy. That's why I like the single-family rentals. At the end of the project, when my project is fully rehabbed, I could technically have someone come in and buy it vacant at that point. Or I could have someone, and I did have one person at one point that liked the house, but they wanted to move into the house. So that was kind of like a retail flip for us. And we sold the house to that person to move in. So it was not we bought a rental, but it turned into a retail flip in the end. You could also, at the end, so you have the tenant in place, now you have a couple of strategies. You could sell as a turnkey single-family rental, or you could also refinance it and then keep it as part of your portfolio, or refinance it and wait for a little bit, for a couple of years, and then and sell it at that point as well. So a longer kind of like flip situation. So you have multiple exit strategy, and this is obviously going to reduce risk. You may also want to use other people's money. So we've used a lot of private money lenders in the past, and we've used also joint venture investors. And depending on how risky we thought the environment was, in terms of interest rate or in terms of we didn't know where the market would go, we would choose whether we would want to go a joint venture or private money lender for these investments. So if the market was doing great, we would use private money lenders because we had a fixed cost for financing the deal. If we were not sure if the market would go down, or if it would take longer to sell the property, instead of taking 6 months, maybe it would take 9 months or something like that, or it was a new market for us, then we would use joint venture in that case, and we would share the risk. The thing is that, yeah, you share the risk, but you also share the profit. So if you did a good deal, then your investor is still very happy because they make a good return. And at the same time, you're very happy because you minimize your risk, and you also have a good return. So this is good for everyone. Finally, if you're part of the Flip System program, you can rely on the coaches. We have coaches that are specializing on the construction side. We have coaches that are specialized in the acquisition and negotiation part of it. We have coaches that are going to help you sell your property. So all of these coaches are going to help you with your deal throughout the life cycle of that deal. So this is obviously the most interesting way to reduce your risk. So the 5 lessons that I learned from this book that you can apply to real estate, I think more efficiently than you can in the stock market, is to exploit market inefficiencies, do your due diligence, focus on value, have a long-term perspective, and finally reduce your risk. So if you incorporate these principles from the margin of safety, I think it's going to really help strengthen your strategy, your real estate investment strategy, and you're going to see some positive return. And I hope I saved you this $1,800. I hope you enjoyed that. I hope you enjoyed this video. Again, I'm here to help you make more money and build some financial freedom, some passive income. If this is something that you like to, make sure you like and subscribe to my channel, and we'll see you next time.